Meet Marcus, a 32-year-old mechanic workshop owner in Phoenix making $68,000 a year. 5 years ago, he opened his own shop after working for someone else for nearly a decade. The business was doing well, steady customers, reliable income, but Marcus had a problem. Despite earning decent money, his bank account looked almost the same as it did 3 years ago. Every month, money came in and money went out. He paid himself, covered expenses, reinvested in tools and equipment, but wealth, real wealth that could give him options, freedom, maybe even early retirement, that wasn't happening. Then Marcus discovered something that changed everything: the 8-4-3 investing rule. It's a simple mathematical framework that explained exactly why he wasn't building wealth, and more importantly, how to fix it. Within 18 months of applying this rule, Marcus had built more real wealth than in the previous 5 years combined. Not through luck, not through risky speculation, but through understanding how money actually multiplies when you follow a proven system. My name is Ryan, a financial specialist. I spend way too much time analyzing how everyday money decisions actually play out in real life. And what I've discovered is that most people work incredibly hard but never build wealth because they're missing one critical piece: the mathematical structure that turns income into lasting assets. Let's break down what the 8-4-3 rule actually means and why Marcus thought his original approach was working. The 8-4-3 rule is an investment allocation framework. 80% of your investable income goes into growth assets, 40% into stable income-generating assets, and 30% into liquid emergency reserves. Wait, that's 150%, not 100. Exactly. This isn't about how to split $1. It's about how to structure your wealth building across different time horizons and purposes. Here's what Marcus was doing before. He kept $15,000 in a regular savings account earning 0.5% interest. That was his emergency fund and his investment combined. He thought having cash available was being smart and responsible. The math looked safe. $15,000 sitting there, accessible anytime, no risk of loss. In his mind, this was wealth building. He had more in the bank than most people he knew. But here's the brutal reality. At 0.5% interest, his $15,000 earned $75 per year. Meanwhile, inflation at 3.2% meant his money lost $480 in purchasing power annually. He was getting poorer by $405 every year while thinking he was building wealth.
Welcome to what I call the savings illusion. The comfortable trap of confusing cash accumulation with wealth building, when in reality, your money is slowly dying in low-interest accounts. Let's calculate what Marcus's approach actually cost him over 5 years. $15,000 sitting in savings at 0.5% interest compounded annually grew to $15,377 after 5 years. Sounds like growth, right? But inflation at an average 3.2% annually meant that same $15,000 in purchasing power 5 years ago would need to be $17,568 today just to buy the same things. His safe savings strategy lost $2,191 in real purchasing power over 5 years. Meanwhile, if that same $15,000 had been invested following the 8-4-3 rule, here's what would have happened. 80%, $12,000 in growth assets, diversified index funds averaging 10% annually, grew to $19,326 after 5 years. 40%, $6,000 in stable income assets, dividend-paying stocks and REITs averaging 6% annually, grew to $8,029 after 5 years. 30%, $4,500 in liquid emergency reserves, high-yield savings at 4.5% grew to $5,606 after 5 years. Total value after 5 years following 8-4-3, $32,961 from an initial $22,500 investment. The 150% is cumulative across categories, starting with $15,000 base and adding $7,500 from redirected monthly cash flow. Compare that to his actual result, $15,377 with decreased purchasing power. The opportunity cost? Marcus left $17,584 on the table over 5 years by not understanding how to structure his wealth building properly. The savings illusion operates across every aspect of wealth building. People think having cash in the bank equals financial success. They avoid investing because it feels risky. They prioritize accessibility over growth, and they slowly, quietly get poorer every single year. A 2023 study by Bankrate found that 68% of Americans keep the majority of their savings in traditional savings accounts earning less than 1% interest. Meanwhile, the average stock market return over the past 30 years has been 10.7% annually. That gap, nearly 10 percentage points, is the difference between building wealth and treading water. The Federal Reserve Survey of Consumer Finances shows that the median American household has a net worth of $192,900, but the top 10% have a median net worth of $1,590,000. The primary difference? The wealthy follow structured investment allocation rules. The middle class keeps cash in savings accounts. But the real cost isn't just financial. Let's talk about what the savings illusion does to your future. Marcus spent 5 years feeling proud of his $15,000 savings account. He felt responsible, prepared, safe. But beneath that comfort was a growing anxiety he couldn't name. At 32, he looked at colleagues who were building rental property portfolios, investment accounts, passive income streams. He felt behind but didn't know why. He was doing the right thing by saving, wasn't he? The psychological impact was real. Studies show that people who don't see their wealth growing experience chronic financial anxiety even when they have savings. The brain recognizes subconsciously that you're not making progress. You're standing still while others move forward. Marcus's business growth was also affected. With all his personal money in low-yield savings accounts, he couldn't invest in expansion opportunities. He couldn't take calculated risks. He was trapped in a cash preservation mindset that limited his business potential. His retirement projections were devastating. At his current savings rate and 0.5% return, he'd have $487,000 by age 65. Sounds decent until you factor in inflation. That's equivalent to about $198,000 in today's purchasing power. He'd be working until he died. Let me teach you the complete 843 framework and why each component matters. The 8, growth assets, 80% allocation, this is your wealth engine. Index funds, growth stocks, ETFs tracking the S&P 500. These assets historically return 10% annually. This portion isn't touched for 10 plus years. It compounds aggressively and builds your long-term wealth. The 4, stable income assets, 40% allocation. Dividend-paying stocks, REITs, bonds, income-focused investments. These return 5 to 7% annually and generate cash flow. This creates passive income streams and reduces volatility in your overall portfolio. The 3, liquid emergency reserves, 30% allocation. High-yield savings accounts, money market funds, short-term treasury bills earning 4 to 5%. This is your safety net, accessible within 24 hours for true emergencies. The brilliance of 843 is that it addresses 3 different financial needs simultaneously: long-term growth, medium-term income, and short-term security. You're not choosing between safety and growth, you're structuring your wealth to achieve both. Here's how to implement the 843 rules starting today. Step 1. Calculate your investable income. Take your monthly income, subtract essential expenses, housing, food, utilities, insurance, debt payments. What's left is investable. For Marcus, that was $1,800 monthly. Step 2. Build your emergency reserve first, the 3. Save 3 to 6 months of essential expenses in a high-yield savings account earning 4 to 5%. For Marcus, that was $18,000. This took him 10 months of dedicated saving, putting his full $1,800 monthly into this category first. Step 3. Split new investment between growth and income, the 8 and 4.
Once your emergency fund is established, split your monthly investable income, $1,440, 80%, into low-cost index funds, $360, 20%, into dividend stocks or REITs. Yes, the ratio is 80% 20% for ongoing contributions, which feeds the 8-4 structure over time. Step 4. Rebalance annually. Once per year, review your total portfolio. Ensure your growth assets are approximately twice your income assets. Sell winners, buy underperformers, maintain the structure. This forces you to buy low, sell high automatically. The 8-4-3 rule removes emotion from investing. You're following a system, not chasing trends or reacting to market fear. This is the difference between low leverage and high leverage wealth building. Marcus's old approach, cash and savings, was low leverage. Every dollar worked at 0.5% efficiency, losing ground to inflation. It was wealth preservation at best, wealth destruction in reality. The 8-4-3 approach is high leverage. Every dollar is optimized for its specific purpose. Growth dollars compound at 10%, income dollars generate 6%, safety dollars protect at 4.5%. Your money works at maximum efficiency across all time horizons. Someone who keeps $50,000 in a regular savings account at 0.5% for 20 years ends up with $55,235 after 20 years. Inflation adjusted, that's about $33,000 in today's dollars. They lost $17,000 in real wealth. Someone who invests that same $50,000 using 8-4-3 allocation and adds $500 monthly ends up with approximately $438,000 after 20 years. Inflation adjusted, that's about $266,000 in today's purchasing power. They built real, lasting wealth.
Marcus sits in his workshop office on a Saturday morning, reviewing his investment account on his laptop. 18 months ago, he restructured everything following the 8-4-3 rule. His emergency fund? $18,000 in a high-yield savings account earning 4.5%, fully funded, provides complete peace of mind. His growth portfolio? $31,200 in index funds, now worth $38,400, up 23% in 18 months, building his long-term wealth. His income portfolio, $7,800 in dividend stocks, now worth $8,970, generating $420 annually in passive income, creating cash flow. Total wealth built in 18 months, $47,370, more than he accumulated in 5 years of safe savings. But here's what changed most. Marcus no longer feels behind. He sees his wealth growing. He understands the system. He has a plan that actually works. Here's what Marcus finally understood. Saving isn't the same as investing. Cash in a bank account isn't wealth. It's purchasing power slowly eroding. Real wealth requires putting money to work in assets that grow faster than inflation. The 8-4-3 rule isn't about taking risks. It's about structuring your wealth intelligently across different asset types, each serving a specific purpose. Growth for future wealth, income for present cash flow, liquidity for emergencies. The shift isn't about earning more or spending less. It's about directing the money you already have into a system that actually builds wealth instead of one that preserves poverty. If this framework changed how you see wealth building, hit that like button and subscribe because I'm breaking down the mathematical systems that actually create financial freedom. The question isn't whether you can afford to invest. It's whether you can afford to keep letting your money die in savings accounts.